Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the first weekly economic review of 2023. So, a happy new year to everyone out there. Health, prosperity, good returns in your investments in 2023. So, I thought I'd start. Well, let's start with the usual recap of the last week. So, first time I've seen black in the top part of this table since I don't remember when, maybe very early 2022, if that. But positive returns on the year for so far for fixed income. So small victory there, but we've had a lot of action over the last 2 years in fixed income. Positive week there. Equities, TSX outperforming the Nasdaq and the S&P 500, so continuation of that theme. Emerging markets have been outperforming for a couple of weeks or months now, and the trend continues. So let's see if these are trends for 2023. Positive returns for fixed income, outperformance of the TSX and emerging markets versus the U.S. stock market. That could be what we see throughout the year, but the year is still pretty young. So this is the picture after 1 week here. Now, if we want to recap 2022, we need to also remember where we stood when the year started. So this is a look back at market returns in 2022. So on the right, you have 2021, and I'll start there. So we had negative returns in 2021 for bonds and in 2022. So we already have 2 consecutive years in the books. 2023 could be positive. This is our base case. This is what we expect. But, as I said, very early in the year. For equities, remember that when 2021 ended with very strong returns, 20 to 30% in North America, 18% in Europe and Asia. Emerging markets have had a negative stretch with especially China underperforming for 2 years now, starting to see some interest from investors again in China, but it's a theme that will flesh out over the coming months. But markets were very expensive at the end of 2021. When you look at price earning ratios and evaluation metrics pointed towards very expensive stock markets. So elevated valuation and historically aggressive tightening of monetary policy is a recipe for what we've seen in 2022. So red everywhere, bear market in the US, on the S&P 500, on the Nasdaq. We avoided a bear market on the TSX, so we never saw a pullback of 20% from the most recent highs. So we're still in the bull market for the TSX. EFI negative, emerging markets negative. But now that we ended 2022, valuations are very cheap in Canada. We're talking about first decile for the PE ratio in Canada. So there's a margin of safety there. The S&P 500 and Nasdaq are still expensive on an historical basis, but they're not as expensive as they were at the beginning of the year. So there's a foundation there for potential positive returns in 2023. Should be a volatile year. First half of the year could still be tough until we see the revisions to earnings and the market just getting to just wrapping its head around the fact that we could have a recession and everything that it entails. So the bear market process should continue. So first half of the year looks sketchy, but the second half of the year could be more positive. Again, very early in the year, so we'll keep you posted as we move forward. But 2022 is in the books now. One of the important themes of 2022 was also the strength of the USD. So weighed on the Canadian dollar, weighed on the euro, of course, versus the USD. And interestingly, the price of gold went nowhere during the year, so no direction from gold. Could be an interesting story to follow in 2023. We'll keep you posted when we make or change our views there. So Graphically, what that meant was when we said that, I mean, we've shown that chart a few times already, but a year for the ages, returns on bonds on the horizontal axis, equities on the vertical axis, and 2022 is by itself on the bottom left. Typically, you have positive returns for both asset classes or one of the two diversification, and that was not the case in 2022. You need to go back to 1969 to see a year like that, and this was in fact the third worst year for a balanced portfolio of global equities and bonds. So a year for the ages. So that's what you get when you have very elevated valuations and a rapid tightening of monetary policy. So it's in the books. Now that we're in 2023, if we go to the next slide here, well, see that we've had a negative year for on Wall Street. So not on the tail left, on the left tail, but still one of the worst years in history on Wall Street. And if you look at the table here, now it's very rare to see consecutive negative years for the S&P 500. We did ask the question in the last review of 2022, would it be possible? And the answer is that it's very unlikely, but yes, it's possible. But if you look at when that happened, two consecutive negative years, was when the valuations were very, very elevated on a historical basis, and the current environment still qualifies for that. So it's not the base case scenario, but there is some probability that we could have back-to-back negative years on Wall Street. The forecasts from the strategists here on the right, as you can see, the red line is where we ended the year. Some are pessimistic, some are very optimistic, but I'd say that the crux of the crunch of the distribution here, the middle part, is pointing towards a single-digit positive returns for 2023. So the track record for strategists at the beginning of the year for forecasting the end year level, it's not good, but still just wanted to share that with you. That consensus is pointing towards not very strong, not very negative, but maybe small positive returns for 2023. So we'll see how things unfold. The story to follow in 2023 will be the Federal Reserve. Once again, it's always the Fed, but maybe this time more than other years. Well, not more than 2022 because that was quite a year, but still more than a typical year. So here you have, well, there's two slides coming. The first one is the Fed is saying that they're cushioning against prematurely loosening monetary policy. So the message is that when you fight inflation, you fight it till the end. So don't expect the Fed to start cutting early, even if there's a recession. The market on the right is pricing in rate cuts starting in July of 2023. So this is not consistent with the Fed's message. So there's room for market adjustment, for volatility, for fading investor sentiment. If the Fed continues to push on that, if that's what they do, at some point the market will have to come to the reality of things, and that could mean volatility in the market. Of course, the Fed could change their mind. They could bend to pressure from the markets, from political pressure, any kind of pressure. Our base case is that they will keep rates elevated all the way through 2023, maybe cut somewhere in 2024. So the market will have to come to grips with that, and that could be detrimental to market performance in the first half of the year. This is our base case scenario, but let's see, maybe the market is right. Let's see, but the investors that play that correctly will be the ones that will be posting the best returns in 2023. So this is part one. Part two here is that the Fed is also leaning against any easing of financial conditions. What they want to do is to tighten financial conditions. That mean higher interest rates and lower stock market, because if the stock market rebounds, that means that businesses can, just print more shares at a more elevated, a higher price, which is easier financial conditions. And the chart on the right shows that financial conditions have eased quite a bit since November. So expect the Federal Reserve, other central banks, to push back against any strong rebound in the stock market. So we could have Fed speak that pushes against that. So those are the things to follow in 2023 that will determine the direction of the market and the winners from the losers here. So looking forward in 2023 on the economic side, the US PMI continues to slide. The coming months are not looking good. We had the print for December, which was again below 50 and still sliding down. So like clockwork, following our leading economic indicator that we've been showing a few times last year. So the trend continues to point downwards. It's important to understand that the odds of a recession are elevated, and economic data should be heavy for a while. Now the labor market will be in focus. So we had the first print of 2023 here, numbers for December. Let's start on the right in the US. Slowing down, but still a strong creation of jobs. But positive surprise this morning. Less pressure from wages, at least it's decelerating quicker than the market was expecting. The stock market is cheering that, so that there is good news there, so it could be supportive, but it will take more than 1 month of data before the Fed changes its mind. When looking at the things that I mentioned, they seem to have a strong resolve. On the left, you have the Canadian job market. Strong surprise to the upside. For the consensus was for 5,000 jobs to be added, and we had over 100,000 jobs. After the summer lull, now we're starting to see a strong rebound, which is pointing very heavily towards one more rate hike in January, on January 25th. The consensus was not there. We were expecting maybe we would jump over that date, maybe look for a hike somewhere in the second decision of the year. But now with the labor market being so strong, unemployment rate falling, participation rate rising, salaries, wage growth continue to be strong, and importantly, GDP in Q4 is pointing towards 1.2%, but the forecast from the Bank of Canada was 0.6%. So the economy is twice as strong as what it was expecting. So the odds are pretty strong that we could have a rate hike on January 25th, and this is pushing interest rates higher this morning. So that wraps it up for the week. ia.ca/economy. You can subscribe to the newsletter if you haven't done so already. Podcast, in your interest, we recorded 2 episodes of the recap of 2022 with my friend and colleague Marc Gagnon. Those are available. If it's not available already, it will be next week, but there's an outlook for 2023 again with Marc Gagnon, so very interesting content there. I encourage you to give it a look. Economy Finance 101, there's some new material that's been recorded. Now we're in the editing process, but it's coming up. And Twitter, LinkedIn, as usual, you can follow me there. So thanks everyone for your support, and I'll be back again next week.